Good evening, everyone. You can see our presentation about today's webinar. We will start from the UK side, since the budget the UK, we will start to present the news of the budget, and then we will go to analyze the options that if you decide to leave the UK, you can choose between Italy, Switzerland, and UAE countries. So the first presentation will be about the budget in the UK, and I'll share the presentation with Giacomo Francioni, our colleague partner from the London office, with me. To follow then will be Luigi Belluzzo, Domenico Sanicandro from the Italian office, Luca Luoni from the Swiss office, and myself to conclude from our new office in Abu Dhabi in Dubai. So to start, I'm sure most of you have received our comments on the budget, but we'd like to go through the overview of what we think are the most important news about the budget. The first one, of course, is the abolition of the concept of domicile. So we are now going to use the same concept as in the civil law countries. Domicile is residency. And there are so many effects about this, but also there are also positive effects about this, because finally in the tax treaties, both for income and capital gains and inheritance tax, a very important one with Italy, for instance, we can use the concept of residency. Then, of course, there's been the increase of the capital gain tax and the employer national insurance that I'm sure you've seen all the comments about, and some other news about the stamp duty, an increase on the stamp duty, of course, that we were expecting to go from the 3 to 5%, and then basically, if you are not UK resident buyer, there will be a very big increase on the stamp duty. So something that you should look into it before deciding whether to invest or not in the UK. Then the other big news was indeed the news about the relief on the agriculture and business properties that starting from April 26, it will no longer be 100%, but will be 50% of asset over 1 million asset over 1 million agricultural business property. And this is something that has a big impact in the estate planning of both domiciled and not domiciled individual on the old concept, and with the new concept of both resident and not resident individuals. We will comment further to this later on, but this is a big and important news. I would say probably the most important news about the recent budget. So to go ahead, before leaving the floor to my colleague Giacomo, I will start about considering an option for someone that is a new resident. So if you were to come to the UK from April 25 as a new resident, please bear in mind that you will no longer be considered not domiciled, but you will be considered resident under the statutory resident test rules that has not changed, and you will be taxed on the worldwide income and gains plus inheritance tax, only if some conditions are applicable, based on your residency. So this is the most important point to start with. So what if someone moved to the UK? So the good news that someone that is newly resident in the UK can apply the so-called FIG, and it will be possible for someone that's not been resident for the last 10 years to apply the FIG. The FIG allows an individuals to claim exemption from UK tax on the foreign income and gains on the first 4 years of their UK residency. To claim this relief, this is something quite important to notice, that you can claim this only through the self-assessment tax returns, similarly to when you were claiming the remittance basis, basically. And you can make the claim for any or all the 4 years. And it's very important to notice that you should be not considered resident for the last 10 years by the application of the statutory resident test. So even if you are not considered to be resident in the UK for a double taxation agreement that UK has in place with the other country, you will not be able to apply for the FIG because the statutory resident test prevail for FIG purposes, the double taxation agreement. This is something that I'm sure, and I'm the one that is starting as well to comment on this, will have some comment on this because it's something quite unique that should be addressed in the legislation. Or by the practitioners, of course, such as myself. So that's an important news, and that's a relief that we think can attract some people to decide to take up residence in the UK, because it will be a very similar concept as before. So you will not be taxable for income and gains and inheritance tax assets that you have abroad. Then another change in the legislation is about the overseas workday relief that is still possible to apply. Of course, there's been, again, the difference on it will be based on the residency, and it will be possible to claim it up to 4 years only for income that you earn from working outside. And there is a limit now on 30% of the qualifying employment income, or 300,000 income of the employment income. So again, something new, but we think that is something that can attract people to become resident in the UK. But before deciding to become resident in the UK, you should take advice, and especially you should apply for the statutory resident test, not only for the year that you decide to become resident in the UK, but also for the previous years. Because once again, you need to make sure that you're not being resident in the UK for the last previous 10 years by the application of the statutory resident test. So it's very important that you do this exercise with your advisor. And again, individuals that are newly arrived in the UK, they can claim the exemption by the FIG, income and capital gain tax. And again, on the inheritance tax, there will be no taxation on UK not situs asset. So similar like today, it was before the budget, similar that was before the budget, there is no taxation on foreign UK situs asset, only UK situs asset for the first 10 years of residency. After that, things might change, and hence why I like to leave the floor now to Giacomo Francioni, that will talk about an option that if you decide to stay. So if you decide to remain in the UK, what are, Giacomo, the consequences, please?
Thank you. We took a practical approach in thinking about the situations of people deciding to, if they want to remain in the UK. Of course, the remittance basis has been repealed. But for the income and gains that were left abroad by a remittance basis user, any remittances to the UK are still subject to UK tax. So what is the transition relief that has been introduced by the government is a temporary repatriation facility, the TRF, which allows the individuals, the non-domiciled individuals from April 2025 to repatriate the income and gains from abroad at a reduced tax rate of 12% for the first 2 years, 25, 26, and 26, 27, and 15% on the third year. And this is an important tool for the non-doms with income and gains abroad that can basically repatriate, remit income gains from abroad at a favorable tax rate. And this is, of course, this needs to be claimed through the self-assessment in tax return in the relevant year. So therefore, within the 31st of January of the following year after the year end. And yes, so for people remaining in the UK, one of the most important changes introduced by the government is related to the different way the inheritance tax is levied. And for the non-doms individuals, the UK assets, of course, will remain taxed in subject to inheritance tax. But for the non-UK assets, the situation and the way they are subject to tax will change, and it will now move to a tax to a residence tax system. So they will be taxed after 10 years of residence. And this system will allows the spouse exemption, keeps on allowing the spouse exemption between if both spouses are long-term resident. An election will be still allowed for the non-long-term resident to be treated as in the same way as the spouse, as it was in the past for the non-domiciled individuals. And of course, it's very important, the statutory resident test, because everything will be based on residence. So we cannot stress enough how important it is now to be correctly advised on the tax residence in the UK. If the persons have been resident for 10 years, they will be subject to UK inheritance tax on a worldwide basis. And if they decide to relocate abroad after the April 2025, they will be subject to the so-called tail. So they will remain subject to tax in the UK for 3 years after they actually moved abroad, if they have been resident for a period between 10 and 13 years in the UK. After the 13th year of residence, the years of tail will increase by 1 year for each additional year of residence, up to a maximum of 10 years when the person reaches the 20th year of residence. Of course, this is very important to be considered for all the relocations abroad. So we thought about the third case of a person decided to relocate abroad before the end of the current tax year, so before April 2025. And the transitional rules will be applicable if the person are resident in the UK only in 24-25, but not in the tax year 25-26. So in this case, they will be subject to the previous called deemed domiciled rules. So only the persons with a deemed domiciled status, so being resident for 15 years out of the last 20, will be subject to a 3 years IHT inheritance tax tail. So the non-UK domiciled with less than 15 years of tax residence will, deciding to move before the 5th of April 2025, will be subject to no inheritance tax tail in the next years. The subjects, the individuals domiciled in the UK by general law, will remain subject to the inheritance tax tail for 10 consecutive tax years with no transitional rules applicable. So it becomes very important, the analysis of the double tax treaties between the UK and the few countries with the UK as tax IHT double tax treated with. And of course, there are two main groups of treaties. And one you can see on top of the chart is allows a credit for foreign tax paid in the UK. And the tax treaties with France, Italy, India, and Pakistan are subject to having been signed, entered long time ago. And they're subject to different and sometimes more favorable rules, and they need to be analyzed in considered in depth. They can become very important for people relocating abroad. So we have two cases in a person of a non-domiciled individual with 11th years of residence, who decided to relocate from UK and becoming non-UK resident in the tax year 25-26. For this person, the transitional rule will apply, and the individual, Marco, will not be subject to UK inheritance tax on his non-UK assets from the 6th of April 2025. The individual, Marco, needs to consider that if becomes a UK resident again, the 10-year residence rule will apply, and if he spends 10 or more years in the UK after 2025, his non-UK assets could become subject to UK inheritance tax. So becoming again a UK resident after returning to the UK could expose the individual to UK inheritance tax. The second case is a case of deemed domiciled individual that have been resident for 17 years and is now currently non-UK resident. So since the person was deemed domicile, will remain subject to long-term residence for IHT purposes and under the transitional rules. So they'll, as a long-term resident, Sylvia's non-UK assets will be subject to UK inheritance tax until the 6th of April 2027, so for three years. And the application, it's crucial to consider the application of the double tax treaties, and this could provide relief to the case under exams. So the Sylvia overall IHT liability.
So thank you, Giacomo. On this, if I may comment, it will be, again, extremely important to understand that the concept of domicile is gone. And in the reference in the treaties, for instance, between UK and Italy, speaks about domicile, but there is a provision that says the domicile is with reference to residency. So therefore, if Sylvia were to go back to Italy, where she comes from, then we can apply the treaty, and this will have a favorable effect immediately on the estate planning of Sylvia by the application of double tax treaty. So to conclude, before leaving the floor to Italy, I think that there is a scope to say here the first and most important exercise that everyone should do is to assess the potential impact of the new rules and to apply a statutory resident test for both people that are coming to the UK or people that are leaving the UK, because it is the most important and crucial test to determine your residency, and therefore the application of the new rules, and therefore the application of any advantage that you may have with the FIG for foreign income and gains. And again, it's also crucial to revise your wills and estate planning, or to update any estate planning, or to do any wills that you haven't done because of the new rules on inheritance tax and the tax treaties. And again, we recommend that you always receive tailored advice, a bespoke advice from the country you're coming from to UK, or from UK to the country you are going to. And so with this in mind, I like now to leave the floor to Italy. I'll leave the floor to Luigi Belluzzo. I'll change my slides on the screen. Thank you.
Well, let's move to Italy, where, of course, we have a quite engaged team about immigration and relocation. Just wanted to point out that our team is made by avvocati and tax advisors, commercialisti, and therefore we can look after both immigration rules and tax relocation. I leave the floor to Avvocato Domenico Sanicandro, a colleague of us in Milan, for this initial speeching.
Thank you, Luigi, and hello, everybody, and thanks for sharing your time with us today. So, moving to Italy, let's start with 2 points in particular of today. We would like to analyze and give a brief comments regarding the tax environment and the immigration environment to be considered before moving to Italy. In terms of tax environment, we are going to talk about the most famous, important 3 federal tax regimes that are now in force in our country. The first is the very well-known regime, is the new tax residence regime that has been introduced 7 years ago in the 2017, and that has been reviewed this summer, all in terms of the payment of the tax due that has been increased from 1,000 euros to 200,000 euros per year. This regime is very simple to apply, because the only requirement provided by the law is that the applicant must not be a resident in Italy from the 9 out of 10 tax year. So every people that are not living in Italy in this period can apply for the regime. It's very simple to apply in terms of practical point of view, because we suggest, of course, moving through a specific tax ruling to present and submit to tax authorities, because this is the only way to collect a formal and written answer from the tax authority regarding the requirements provided by the law for applying to the regime. Of course, other important and practical point of view of this regime is that privacy is full granted, because are not to be reported, for example, asset held abroad of Italy, of course, and of course, no remittance concept is in this regime. The second favorable tax regime is the pension regime. It's applied to people that have a foreign and abroad pension that would willing to move to Italy. In particular, regarding the relocation to Italy, in this case, the rule states that the people have to move to the south of Italy, country region, and of course, with the city that are more than 20,000 inhabitants for the registration. And of course, this in this regime, the substitute taxation is equal to the 7% of all your income. So it's very favorable, because of course the tax base is equal, but the tax bracket is very low. And the third regime that has been amended last year is the inbound regime. Inbound regime that in the new rules is applied only to income arising from employment, and is capped to 600,000 euros per year, and allowed to benefit from a reduced tax basis equal to 50%. Of course, the regime is valid for 5 years, and all these regimes are in common that is necessary to move the tax residents in Italy effectively. Another thing that we have to consider, because moving to Italy, in particular for people
Yes, thank you, Domenico. So moving to Italy is, of course, not easy, but at the same time, we know how. We've done many relocations since 2017, and now Italy is among the top destinations, as you probably all know. I prepared only 2 cases. Of course, full disclaimer, we are just discussing with simple things, but it is necessary to take a professional advisor. In this case, the new tax resident moved with a family, let's say 1 wife and 1 child, also 30 years old, so an adult child, and a son. And basically, the husband decided to enter with a flat tax regime. And again, because it is after the 9th of August, it's going to cost 200,000 per year. The wife can be a secondary applicant at 25,000 per year. They both can stay for a maximum of 15 years. But the son can enter with the talent worker or inbound workers regime. And of course, this is a good combination, and it also helped me to say that the 3 regimes that Domenico so effectively described are alternative regimes. Be careful, because beside taxation, you enter a civil law country, so a matter of succession or inheritance is relevant. Of course, we know how to help and advise. You enter in Italy tax world, which is a complicated word, but with this regime is a sort of heaven. And for direct taxation, you follow calendar year, but only for direct taxation, meaning that for inheritance, you don't follow. This is particularly useful, for example, when we need to work with the French citizen or people moving out of France, but also in other things. Already Giacomo described how helpful is the treaty that Italy enjoy. And treaty application might matter. Be careful that it might matters only for the inbound workers on the way in. Unfortunately, the last circular newsletter of a few days ago, the number 20 of November, closed. We don't agree, but this is a decision of the tax administration. They cannot give a consent to application of the treaty in the way in. So the treaties are at your disposal only once you are in the country, becoming a tax resident of Italy. Of course, the whole relocation is in full compliance, also for CRS, FATCA, and tax. The second case is a little bit more complex, but I must say is also very popular. We have already done, and not only us as a firm, but it's quite in the best practice now, because it's before relocation, the new tax resident set up a foreign discretionary trust, probably regulated by Jersey law. This is going to take some assets abroad previously owned by the new tax resident and now administered by the trustees. This gives some faculties, including the fact to keep some retained power on the new tax resident, on the settler, and this is compatible with his fact of being a new tax resident and tax resident in Italy. So this is quite sophisticated, but very helpful, because it gives you some options very helpful on trust and estate planning.
Thank you, Luigi.
I'm finished. Only one thing. The beneficiaries of the descendants now is very clear that they can receive benefit from the trust, even if they are tax resident in Italy. So this example is quite an interesting, complicated stuff, but in full compliance could be very helpful, and many of our clients already made this application.
Thank you. So before leaving the floor to Switzerland, since this is a main webinar on the UK budget and the effect should you decide to leave the UK, I'd like to comment on this slide on something quite actually difficult, and still the legislation to us is quite unclear about the inheritance tax application on trust. Even if you were to leave the UK, you need to be very aware that potentially even the trust of a person that has been resident in the UK, settled the trust, and now decides to move to Italy, could potentially, or to another country, could potentially be within the tail of the inheritance tax in the UK. However, if you decide to go to a country with a double taxation agreement like Italy on the inheritance tax, this might be very, very helpful also with regards to trust. This is something that in the past, previously of the budget, as Luigi was saying, we were doing quite plain vanilla. Everybody was coming from the UK with a previous trust set up in Jersey, will benefit even more than remaining in the UK as a resident by taking proceeds from trusts as beneficiaries and remittance into Italy. Everything was, of course, thanks to the not flat tax and the non-resident tax, and so the flat tax regime. But now, because of the changes in the UK, needs to be carefully advised the client that comes from the UK with the trusts, regardless of being resident abroad. So now I'd like to leave the floor to Luca Luoni from our office in Lugano. Thank you, Luca.
Thank you to everybody for attending our webinar this afternoon, and thank you, Alessandro. I'd like to start my speech, which is about the Swiss forfait regime, which is better defined as to the taxation according to the actual expenditure. And this specific form of taxation for individuals is provided by the Swiss law, both at the Swiss federal level and by the tax law of the most of the cantons, with some important exceptions like Zurich, Basel, Schaffhausen, and Appenzell other roads. And but at the end, how does this special tax regime works? It can be actually applied if you don't have, first of all, Swiss citizenship, if you become a Swiss taxpayer for the first time or after an interruption of at least 10 years, if you don't carry out any business in Switzerland, and in case of couples, both spouses must satisfy the above defined conditions. And with regards to the duration, we have to say, which is unlimited. And this is a feature that distinguishes a lot the Swiss tax regime from most of the other ones around the world. And this is one of the principal features that I think is really important with the Swiss special tax regime. And as said, the lump sum tax replaces the ordinary income tax, but it takes into account the highest amount deriving from the following tax basis calculation. First of all, we have to consider as the basis, as the tax basis, the annual expenses corresponding to the standard of living of the individual or the people he supports, both born in Switzerland and abroad. And for example, we have to consider expenses for food and clothing, for accommodation, for heating, cleaning, garden maintenance, for training, for sport, for holidays, for treatment trips, for the cost for keeping expensive pets like saddle horses, and for the maintenance of operating costs and cars, motorboats, and yachts, and so on. And or else we have to consider and take into account the highest of the following amounts: the legal minimum provided by the Swiss law, which is currently 429,000 Swiss francs per year, or 7 times the cost of rent, of the rental value of the property in which the individual intends to reside, or 3 times the price of the annual pension for room and board. Or again, we have to consider the contract calculation on income from sources from Switzerland or from those countries for which the application of a double taxation agreement is required. And again, we have to say that wealth tax, which is a standard tax in Switzerland, is calculated in this kind of special taxation at 5 times the taxable base of the substitute income tax, and at least it should be equal to the wealth located in Switzerland. Again, with regards to the social charges, there could be a possible liability in Switzerland if generally required by the law. And the same for inheritance and gift taxes. The ordinary rules provided by the tax law of the single cantons apply. And therefore, we have to notice that no special provisions on this topic are brought by the law. And the same is for the real estate profit tax and for the real estate cantonal tax, which are applied the ordinary way. So this is generally and briefly the opportunity that with the Swiss law provides to people who intend to move with a special tax regime to Switzerland. And I hope my speech was of your interest, but of course we will remain at your disposal for any further information or details. And
thank you, Luca.
I leave the floor to Alessandro for the features of the Emirates tax regime now.
Thank you, Luca. So again, since we were considering people coming from the UK, if they don't decide to remain in the UK, we see a lot of interest to Italy, of course, with the regime and the very well-known regime that we discussed before, and also Switzerland, because not only for the Forfait regime, but also for the Favourable state and condition that Switzerland offers, and the lifestyle is also an option that we see in clients at the moment happy to take. We could also speak about other options, but we decided to stick where we have our offices. So Verona, Milan, Rome, Lugano, and then we go often to Zurich. Of course, many clients from the UK are going to Zurich. And the last and latest option that we want to present to you is with regard to the Emirates states, because also we like to share a view that we are opening our offices in Abu Dhabi and in Dubai, since the big interest that we had in the coming in the past month, and we see for the coming years, we think that will be important for Belluzzo to have a presence together with our corporate service providers, Trust and Wealth, in the area. We have already 4 people in our offices. Now it's a bit too late for them to participate, so I decided to take the stage and speak to you about this, because I also will be in charge to the expansion of Belluzzo in the Emirates, and by all means, I'm going next week there because, as I said, we see a lot of interest coming from the UK, not only the UK, but from other regions. So to start with, this will be, of course, shared with you, but I'll just give you a brief understanding of the pathway to the residency and the visa options. The process is very simple, and the benefits are very, of course, clear and important, because if you were decided to take up a investor visa, you can set up your own business, you can set up your own company, and you start to be tax resident in the, you can decide to be in one of the cities of the UAE. We have Dubai and Abu Dhabi as an option, and you can take up then, by holding the investor visa, the option to set up a not regulated entity in one of the free zones, and you can have the investor visa for up to 3 years, basically, with option to renew the visa. The same thing that you can do is to apply for a golden visa, which can be done by investing into specific qualifying companies, or by meeting a minimum investment thresholds, or by applying the golden visa when you decide to purchase a real estate in the region with a minimum value. That everything is basically very clear and quite explained by the authorities. And the golden visa has a benefit to it by giving you a 10 years renewable residency instead of the 2 or 3 years, family sponsorship, so you can come with the family together, and a much more greater accommodation, enhanced mobility, sorry, to live and work and study in the region. And I would say that at the moment we see 50-50 application of golden or investment investor visa, golden visa. And it's very important, and I like to again stress this point. Also with the Emirate and the UAE country, we have a treaty with the UK. So again, it's very important, the treaty, because the treaty will work also to establish the residency. And if you become resident in UAE, you can receive a tax certificate from the authorities, and to allow you to be considered resident by the treaty in UAE. So that's very important for double taxation issues. Unfortunately, there is no inheritance tax treaty, but there is no inheritance tax in UAE, so it's an advantage anyway. In the UAE, we've been working together with many of our partners there, especially with one of the barristers that's very close to us. There was the one in charge and being responsible to create all the news about the DFC and the legislations in the DFC. And then we've been working very closely with Abu Dhabi Global Markets, ADGM, where they can offer pretty much the same kind of solutions to high net worth individuals or people that want to invest in the UAE by using, for instance, a very important concept that is that they can use in both financial centers the common law. So when you invest in this such of the two, DFC and the DGM, you can apply the common law. So that's a very important point. And you can also set up common law vehicles such as trust, foundations, and specific kind of other companies. The UAE has been ranked globally for high net worth individual #1 both with the DFC established in 2004 and the ADGM in 2015. I would say that there is a clear difference between the two, and you can tell by also visiting the two, and we can, of course, taking you there and then showing you the differences and the options that you have. And both are very, very clear, easy, and I would say robust option for you if you decide to invest in the country and go and live there as a resident. So there are many, many chances. You can set up a family office, an holding company. You can benefit from the new legislation, the foundations, and I would say also the new environment about banking industry and financial markets, especially from London. A lot of the financials are moving to Abu Dhabi at the moment, whereas it's more commercial on Dubai. Foundations and other vehicles are pretty much working like for the UK purposes and other offshore jurisdictions, so I wouldn't go there, but I would say that they offer you very much asset protection, privacy, and flexibility and confidentiality. So the same is with regards to companies. Companies, they can be, again, legal entities with different English common law familiarities and rules, and they can be set up in the DFC, in the ADGM, and they can offer you all these benefits. And of course, I was also, with reference to the DFC and the ADGM, telling you that they are both based on the common law, and they can, of course, be offering you the same flexible structure that maybe you are used to get in Jersey, Guernsey, Luxembourg, in the country of the UAE and the Emirates. So what we can offer for you in the area is our usual services, advisory, litigation, business and compliance, and service and solutions, so we can support you for the visa, property search, lifestyle and family integrations, and we can support you, of course, as well of setting up foundations or other vehicles that you would like to have as an estate planning tool. So I'm cautious that we want to finish by 6, and I'd like to leave the floor for some questions and answers. So
there are some
chance,
questions.
of course, to produce this webinar Q&A, as you can tell. Yes.
No, there are some questions.
Yes.
The first one is very easy, and the presentation, yes, it will be shared after the seminar, so easy. The other one I read probably is for the UK, either for you, Alessandro, or for you, Giacomo. Let's have one maximum 2 minutes answer, because there are two other queries. The first one is the concept of anagrafica residence in UK is different from the one of tax residence? Question mark.
The concept of anagrafica residence in the UK is different. Yes. So Giacomo, I'll take this, and then of course we can answer in writing as well. I would say that we can say that it's very different, and you can, if you wish, retain, for instance, your settled status in the UK without being resident in the UK, and therefore it's important that you apply the so-called statutory resident test to make sure that you're not resident in the UK. If you are referring to that, Maurizio can see the name.
Then another question, which is not so easy. It's one individual can be officially resident in Italy and therefore enrolled in the anagrafe, so the civil role at the municipality, and still be considered UK tax resident, or both? Of course, yes.
Yes.
Because there are two different tracks. And then the question is about direct taxation and inheritance tax. Because in Italy...
Yeah, on the inheritance tax, the concept, and of course we cannot give any advice today, but the concept of domicile has changed, and the residency concept is now the one that counts. And on the inheritance tax treaty, the reference in Italy, is quite clear. There are certain kind of assets and taxation that are considered to be taxable only in Italy if they were to be based in Italy, and only in the UK if they were to be resident based in the UK. So a real estate that is in the UK, regardless of the treaty, will be also taxable in the UK, a real estate that is only in Italy will be taxable only in Italy. And if I may, I will take the chance now to tell you something that is something quite important, and few have considered that. Now, because of the new concept of BPR and agriculture, if you were to have an investment in the UK company that invests into agriculture or into a business, whilst before you had the exemption of the business property relief, now you will be subject to tax, even if you are a foreigner resident, like an Italian resident that owns a company in the UK, that owns a business in the UK directly. So an Italian taxpayer that owns a UK company with a business, you will be liable of inheritance tax because it will be a UK situs asset or situs asset, as you like to say.
Okay.
So that's a very important point that.
Then a question to Luca about Switzerland and trust, very quickly. It is possible to plan, of course, in full compliance. Now we are not making a, it is possible, are trust and becoming Swiss tax resident compatible?
Yes, absolutely, absolutely. We have to say that for applying the Swiss special tax regime, we have to draft a special ruling with the tax authorities, and we had experience in the past with trust with settlers that moved to, or beneficiaries that moved to Switzerland, and the trust have been accepted by the Swiss tax authorities. Depending, of course, on the structure, but generally speaking, we may say yes, trusts are allowed within the special tax regime.
Okay, thank you, Luca. A question for you, Domenico, because you say before, this was paying a lot of attention, that for immigration, the investor visa speedy way could take between 3 and 4 months. Two questions very related. One, how long does it take the new tax resident regime if I want to make a ruling, and if they are consequent or they can go parallel? Remove the mute, which is a video conference otherwise.
Of course, they can move in parallel. Regarding the new tax resident regime, once submit the ruling, the tax authorities have 120 days for answering, and they can, but only once, require more additional information and documents. After this request and submitting the document requesting, the tax authorities have only 60 days to answer. Of course, in case of no answering of the tax ruling, is considered as a positive answer, but don't worry, they answer every time. And regarding, I don't remember the question to the immigration, it's yes, the investor visa takes 3-4 months for collecting not only the visa, but also the resident permit. So we have to go to the police headquarters to get a fingerprint, and there are 2 procedures in one. And in general, this procedure requires 1 year, 1.5 years.
That's why it's a speedy way.
Thank you, Domenico. Is there any other question? Because I cannot see Luigi, or is there any comments that you want to do in it for the Italian tax regime or purposes with regards to the new circular, something that you want to add not before?
Look, for the purpose of this video meeting, it is quite relevant what is happening in the UK. Of course, it has been briefly explained, but it needs a deep understanding. So it's very relevant that everybody check and see its proper case. What we are seeing now, of course, from Milan, is that the 200,000 did not stop the flow. It was a little bit in September, but of course, paying 100,000, 200,000 for some people does not make the difference. It is the proper time now, because what is relevant is timing. And if you have an idea to move to Italy, do remember that for direct tax purposes, the calendar year, therefore you need to become, to be in Italy as a resident and therefore tax resident in the first month, so May, June. We can do magic, of course, later, but this is now the moment to plan if you think to move. Last but not least, Alessandro, I think that the idea of the FIG is anyway a good way to compete with, for example, the Beckham rule in Spain. So it will be very interesting in this global mobility of people and assets that we are currently seeing worldwide.
Yes, the only thing I like to conclude with is that many people, maybe they had applied in the past the so-called arising basis from the UK. So you will pay tax on a worldwide basis. So you are not applying the remittance. That's an important point that you need to check. If you ever applied the remittance, then you can have some advantages. If you have not, you will not be able to do the repatriation, for instance. Again, if you haven't never had applied the remittance, maybe you always applied the arising basis because there was no point for you to apply the remittance. Be careful that from next year, you have as well the concept of the inheritance tax worldwide to be very aware of. So we think that you should make time with your advisor, with us, of course, if you wish, to also look at your estate planning. You look at your estate that you might have abroad, or you might receive from abroad. Look at the wills, trusts, and other protections that you can still obtain from the using one of the tools that are available, because maybe we haven't had the time to go very deep on that, but just again is things like mirror wills, gift between spouses are still available. So the estate planning is still possible, but is very important that you do it now, because you cannot overlook anymore the estate planning and wills and estate planning that you might have overlooked in the past because you are not domiciled. So that's a very important point, more than income and capital gains, because overall we think that this budget on income and capital gains is, of course, different from the one before. It could have been even worse, but the big difference has been made on the concept of residency, on the concept of inheritance tax and inheritance tax tail. So with this, I would like to conclude within the time limit. I would like to thank you very much, and we welcome you to our office, and both in the UK, in Italy, in Switzerland, and the new offices in the Emirates, and it would be a pleasure to see you soon. Thank you.